A stock we're buying is the topic of today's presentation. And you may be taken back by that because we don't typically talk about stocks that we're buying. We don't talk a lot about stocks that we're bullish about. That's because everyone out there tells you what stocks you ought to invest in, but very few pundits tell you what stocks to avoid. You won't find many risk-averse tech investors, and that's the approach that we take. We value wealth preservation even more than wealth growth, and that helps you sleep well at night, the old acronym SWAN. So over the past few decades, we've become very good at finding landmines, and I won't expound upon our track record of doing so. At some point, we'll have to do a video on that. But you're never going to avoid them all. So what we try to do here at Nanalyze is teach people how to become better investors. And in order to direct this business as the founder, I spent a lot of time talking to our customers, our subscribers. And here was a critique that we received on YouTube. I don't know if this is an individual who's a premium subscriber, probably not based on the contents of this message. This gentleman says, I remember you saying you save the investable companies for your premium subscribers. Of course, I understand why you do that, but it means the channel's very negative. People don't want endless negativity. They want something optimistic, actionable. You've got to throw them a bone occasionally. You can't leave everything good for premium subscribers. Well, I think this gentleman has a point, because when you look at the tools and reports that we provide our paying subscribers, you'll see here, this is a set of some of the benefits of what premium subscribers receive. If you look at the first category there, our tech portfolio, we're holding 37 tech stocks. And throughout these videos, I know because I present them all, we drop quite a few hints about what we're invested in. We'll say it in passing. We won't make it a point to explicitly say that on the slide, but you could probably figure out, I'd say, a good third of the tech stocks that we're holding. Then we have our tech report and tech stock catalog. That catalog contains over 460 stocks. It's an Excel spreadsheet. Has about, 20 to 30 fields of data. It's very rich and useful. The report is more verbiage, but combined between these two, there are 65 stocks that we like. That means we'd consider holding them, but we're not, and 6 ETFs that we like. Moving on to the right there, you see that new money portfolio. That's our newest product. These are 20 stocks, 10 disruptive growth, 10 dividend growth that we believe are the most compelling right now. However, a couple names in there we don't actually own because we had invested in substitutes prior to producing this report. Then on the right, you see our dividend growth strategy, Quantigens. We're holding 30 stocks. That's where the majority of our assets lie. So collectively here, there's about 120 stocks we like. So I think that this gentleman's request for us to throw a bone is valid. But before we do that, I wanted to talk a little bit about how we decide what to cover on this YouTube channel. We run it for one reason. That's to generate leads. These days, when you're selling a financial subscription product, people need time to see the value that you add to their investment process. So we consider subscribers of our channel to be leads. The priority of this channel, therefore, is to grow subscribers. So the categories of topics that we're going to cover, these sometimes overlap, but there's 3 categories. First, these stocks that generate a lot of attention from retail investors. And unfortunately, there's a lot of junk in there, and that's where we get in front of, most of the time, newbie investors who don't know any better. 2, the second category, this would be DGI pieces, 2 birds with 1 stone content. So these are things that we've had to cover anyway. So maybe in our dividend growth strategy, there might be a good example would be the recent video on Coke versus Pepsi. That's a classic piece where we're looking at making decisions in that strategy. And then third, topics raised on our Discord server. This is for subscribers only, people who are paying us money. And we may look to open up a YouTube subscription soon that allows you to participate only in the Discord server. But people raise lots of companies there. We have some great banter. And from that, oftentimes will come educational pieces, and that will help drive the topics for this channel as well. In the future, we'll look towards voting mechanisms as we grow. And I think for the rest of this year, we'll be actively experimenting with ways to grow this channel, maybe trying some new themes and things like that. But basically, it comes down to the fact that we don't talk about stocks we own fairly often. We mentioned it in passing. I think a peek under the kimono is a great sales technique, but just remember, a buy today isn't a buy tomorrow. So what you need to do if you tell somebody that you're buying a stock, you need to provide them with a valuation target so that they can refer to that later on. So today we're going to talk about the last stock we bought, and it relates to cloud computing. This is a great piece we did. I'll link to it in the description of this video. Investing in cloud computing. Any growth left? There's a lot of growth left. So this slide you see here, this was taken from Google, and it shows the $500 billion in cloud services spending for 2022 expected to go over $1 trillion in the next 4 years. That's a 20% compound annual growth rate. Anytime you see an industry in the trillions of dollars, it's usually worth getting a piece of. So we recently covered the insurance industry. Globally, it's a $5.5 trillion industry. That's incredibly large. So when you see big numbers like that, you would understandably want a piece of that. And the natural way to do that would be to look for leaders. Well, you've got Google, Microsoft, and Amazon accounting for over 60% of growth. They're referred to as hyperscalers. And you can see here the growth. This would be, I believe, the 2022 year-on-year growth, and the percent of total spend, cloud spending, that goes to each company. You see Amazon in the lead there, but also growing the slowest, having an all-time lowest growth. This is covered in that piece. Now, when you look at how Amazon makes money, I find this fascinating. Look at their business there. You have North American retail business. This is the operating income profitability, right? International, they're losing a lot of money on. Look at how cloud is pretty much propping up the entire company. That's crazy, right? So when we think about ways to invest in cloud computing, we want a piece of that, and we've dug into areas such as real estate investment trusts or providers of hard drives, things like that, very pick and shovel oriented. But when we think about software solutions, having worked in software for half of my career, I understand the appeal of open source solutions. And this company we're going to talk about today, we'll wait a little bit here before we'll tease you before we say the name of it. They say this: nearly all of our paid product adoption began with open source usage. If you're not familiar with open source, it's simply a community of developers who build something that other people find useful, and it turns into this collaborative effort where everybody builds a particular product and utilizes it, and it becomes, these will establish cult followings, and they're very effective in crowdsourcing product development very quickly and effectively, and they turn into an excellent source of leads. Essentially, your customers are coming to you. If you own an open source solution, then you can develop a freemium offering. The community-driven support network is a huge plus, and once people become part of that community, when they switch employers, they'll bring along whatever open source solutions they feel very strongly about. Overall, what this firm does, they reduce costs for people's cloud programs. That's important to remember. We like companies that reduce costs for other companies because they'll do well in good times and bad. Now, this firm is proud to count more than 450 million downloads of our free community products during our 2023 fiscal year. Leads, that's what those are. In the same way that we look at subscribers as leads, they look at downloads as leads. $70 billion total addressable market. This was taken out of their S1. They had an IPO in 2019. And the emerging cloud infrastructure market you see here growing at a 55% compound annual growth rate between 2022 and 2026, and emerging applications and workload orchestration market 88%. So the takeaway here is that they really have 4 segments they're addressing with 4 different product offerings. And we like that because it makes for a very good land and expand strategy. This is a great example of a multinational financial services company that started as a user, a free user in 2019. Then they started paying a bit of trickle of money there, $325,000 a year in the first half of fiscal year 2019. And look at how that steps up. I've highlighted here where they've added products. You see in the first half of 2020, they added a product. Then the second half of that year, they added Well, that would actually be no, that would be down at 2022. So look at that time frame, right? So over 4 years, they went from $325,000 a year to over $10 million. Classic example of land and expand. So if you can do that very effectively, you can grow your business with your existing customers. Now, one of the trends, and our piece on cloud computing looked at this. Actually, this would be our piece on the company. Looked at this movement towards using multiple hyperscalers, and there's this new centralized cloud function team that's being put together in organizations, cloud centers of excellence, platform teams that are responsible for standardizing cloud services, creating operational policies, and centralizing security. So what's happening is that around 60% today of technology practitioners are using multi-cloud. That means they're using a combination of Google, Amazon, Microsoft, or private. That's going to swell to 81%. So there's a trend moving towards utilizing multiple cloud providers. A majority of respondents that Forrester queried say that this helps them achieve business goals. So we see that trend, and that's where our company comes into play, Hashi Corp. They were valued at $14 billion in their 2021 IPO, valued at $4.5 billion today. We love that. We love seeing stock prices slide like that because then we can buy quality at a cheaper price. Gross margins of 83% last year. That's quite good. They have $1.24 billion in cash. That's a lot of money that they can use for whatever they need. They're not burning a lot of cash, so they can use that to make selective acquisitions. They have about 4,200 customers, but 851 customers are generating over $100K and driving 89% of their revenues. Most are on-premise, and they're growing a cloud offering. We looked at this before in a piece, I think it was about PTC, that looks at how if you can get a customer to move from on-premise to cloud, just that movement there will generate additional revenues because they're not having to pay to support that themselves. They're going to pay you to do that. So it's a clever way to grow revenues by migrating your clients from on-premise to cloud. SVR currently, this is our simple valuation ratio. Right now, it's at 8 for Hashi Corp. Our catalog average is 6.5. We bought more shares of Hashi Corp very recently at an SVR of 9. So it's valued even lower than that at the moment. So we think this is a compelling company that when we buy shares, we do it rather slowly. We send an alert to our premium subscribers when we do. But this is an interesting company right now. When you look at their valuation over time, we've calculated that. You can go to Yahoo Finance and do this yourself. Pull up the market caps, then the revenues for each quarter, and then you can break that down, the simple valuation ratio over time. Then you can plot it on a chart. You can see that's been slowly declining. Well, that tells you something, right? So set a target. Say you're only going to buy below 12. What we do for our targets that we provide our subscribers would be to do something objective like take an average, right? So you'd say, well, just take the average over the past 5 quarters and set that as your target. But you might use our internal target for Hashi Corp is 10. So there are always concerns to be had. You should be most critical of companies you're holding, and this is a concern. So their net dollar retention rate is sliding, and their target is 120. So firms will always say, well, it's still above our target of 120. Indeed, it is. But what this means is if they can keep it above 120, then even without any new customers, that means they're growing revenues at 20% a year. Ironically, that happens to be what their guidance is for this year is a 20% revenue growth. But you want to pay attention to that slide, and of course, you're going to get the bog standard, macroeconomic headwind explanation. But what that means oftentimes is that especially if it starts to slide down around 100 or below that, your solution's not sticky and people are finding alternatives, or it isn't something that's critically important to the business. So we'd certainly keep an eye on that and expect it to stabilize. Another metric that you can monitor here, this is a slide taken from their earnings call. Very useful. Haven't seen firms do this very often. You see number of customers over 100K, like we said, 851. But look at the table on the right. Then what you can do is see the average quarterly revenue per customer. You want to see that increasing, right? And then you have the trailing 12-month revenue per customer there, and you can compare the quarterly to that, and the quarterly should be more. That's showing that they're growing, right? And these sort of more rich metrics will, I guess, give you a little bit more insight into or reassurance when you see that falling net retention rate. So as always, with every stock you're holding, find things to be concerned about and to monitor over time. So to conclude, we run this channel for one reason. It's to generate leads. You can't sell people subscriptions unless you prove that you can add value to their investment process. And people who pay the bills here come to the front of the line when it comes to helping us decide the direction of this business. For Hashi Corp, this looks like a solid investment. As I said, our internal target at a simple valuation ratio of 10 or less. So I'm going to put up another video here related to cloud computing that you might find interesting. Before I do that, please click the Nanalyze logo on the right to support our work. We don't run ads. We need your help. Thanks for taking the time to watch this video today.